Today, the Federal Reserve announced their ninth interest rate increase since March 2022, accumulating to a quarter percentage point increase and setting their target rate range at 4.75%-5%. This increase was due in part to inflationary pressure increasing. However, their post-meeting statement suggested that future increases are not guaranteed as the Fed has to keep a close eye on incoming data. The statement expressly noted that some additional policy firming may be appropriate in order to rein in inflation, but it communicated a softer tone than previous communications which noted ongoing increases. The Federal Reserve's rate increase follows a string of banking crises that have broken out throughout the country over the past several months, prompting a closer look into the stability of the American banking system. Although the FOMC statement noted that the U.S. banking system is sound and resilient, it also suggested that the economic activity and hiring may slow, as well as inflation decline as a result of the tighter credit conditions. Despite the warnings, the committee still unanimously voted on the rate increase, which will impact the cost of various consumer debt instruments such as mortgages, auto loans and credit cards. The projections released with the statement did indicate that the maximum peak rate is expected to remain at 5.1%, indicating that a majority of the committee anticipates only one more rate hike ahead. The data also showed increased uncertainty among Fed members with respect to their projections, as indicated by the wide dispersion between the dots. Even so, the median of the estimates point to a 0.8 percentage point reduction in rates in 2024 and 1.2 percentage points worth of cuts in 2025. Inflation is expected to rise 3.3% this year and unemployment is expected to decline to 4.5%. As the rate increases have moved their way through the economic plumbing, there has been a notable increase in volatility in the markets. Investors have been cautiously optimistic, however, as the Dow Jones Industrial Average is up 2% over the past week and the 10-year Treasury yield rose 20 basis points during the same time period. The Federal Reserve has certainly had their work cut out for them in trying to balance both inflation and the banking crisis. Moving forward, they will need to monitor incoming data and economic indicators in order to make sure they take the right steps to stimulate economic activity. It will be interesting to watch how the markets react in the coming months as the turmoil continues to unfold.